milestone in the state of the record rally in stocks. Fundstrat Global Advisors Head of Research, Tom Lee, joins us on set today. Hi, Tom.
Hello.
So based on what Taneo was describing with regard to Bitcoin, what do you think that this most recent rally says about the overall risk appetite in the market right now?
Well, it's really telling us investors are pro-risk. I do think it also just signals how much capital has been idle for the last couple of years, either parked in money market cash or waiting to see if the economy survived. So I think Bitcoin rising is to me, breaking out of a holding pattern is a precursor to what the S&P is going to do the rest of the year.
Speaking of the moves in the broader markets, you say the road to 6,300 is paved with bumps. What do you expect investors to see ahead that may slow them down? What are some of the key markers that you're looking for?
Well, I think there's a lot of macro to digest the next 3 weeks. Tomorrow is the jobs report, and I think investors are fearful that it's going to be too strong because of the hurricane and seasonal adjustment, so it's going to be a big number. Next week is CPI, which has been running a little hot, and Fed Chair Powell spoke about that earlier this week. And then, of course, on the 18th is the FOMC rate decision. So I think once we're through these events, investors can actually then invest into sort of that Christmas Santa Claus rally. So I think 6,300 is still very doable.
So you're basically saying don't go away after the 18th because there may be some additional upside toward the end of the year?
Yes, or buy the dips, yeah.
So, you suggest there that we're in a good news is bad news for stocks environment. Why should the market be concerned if the Fed is going to be less aggressive in terms of cutting rates?
I think there's a conceptual change that the market has to get used to, which is, let's say earlier this year when the Fed started cutting, people thought, 5 cuts is good for stocks in 2025. So if the number gets reduced, it's bearish. I think as we get into 2025, the market's going to shift to thinking the fewest cuts possible next year is the best case because it elongates the dovish cycle. So I think we have to flip the script, but it's going to take some time.
But hasn't that been the case all year? Because in January of this year, the market was implying 6 or 7 cuts. We're only getting a few. We've slowed the pace. The 2-year yield is not that far below Fed funds anymore. So I guess my point is the market's already kind of registered that slower is better.
That's right. I think it's, I would just say it's not a consensus accepted view because, for instance, when Fed Chair Powell spoke about taking things a little slower, the market got weak and then maybe had a rethink. So I think it's going to take a while until markets realize 1 cut next year is actually quite bullish.
Are you surprised that equities haven't reacted to some of the political turmoil abroad, South Korea, France, elsewhere?
In some ways, I think the stock market had been already pricing this in because, as you know, this year has been a pretty significant divergence between U.S. versus Europe and U.S. versus emerging markets and even China's sort of failed rally. So I think in some ways the market's not surprised. Maybe it was even pricing in this through currencies and equity prices.
Tom, I'm going to go back a long ways to our long relationship. Do you still even track active managers and how much, they're trailing their bogeys at all, and whether that's a factor in any way at the end of the year?
Yeah, in fact, we've been cleaning up that data because, as you know, in the last 10 years, there's been a big change in the number of managers. It's good. It's kind of a good and bad year because active managers that tactically went cyclical or more offensive or tech have been having banner years. We have so many clients that are beating their benchmark by 6, 7, 8. These are unheard of outperformance, but it's a small number because, as you know, when you look at the world more towards macro or market neutral, it's been very tough.
So what did these guys get? What did these people get right then this year that are significantly outperforming their bogeys, so to speak?
I think it's a psychology decision they made, which is the companies were telling me things are fine, even at the start of this year, macro people may have told you a recession's coming or the Fed's going to break something, but people saw their companies were doing fine, and the ones that bet on their companies have had great years.
Going back to Bitcoin, Tanea said there's this expectation that it could reach 200,000 in 2025. What's your base case?
Well, our official sort of contours for next year come out on December 11th. Which includes our views on Bitcoin. But I can sort of give you broader observations.
Any little preview, or could you
Sure. We're still in the middle
clues?
of a halving cycle, so I don't think 100,000 is the ceiling. It's really Bitcoin has proven it's now worth 10% of gold, which you mentioned. it's probably going to equate to have the same network value as gold. That's 950,000 or close
It's
to.
more like 1/6 of gold now, right? It's 2 trillion Bitcoin, 13 trillion.
Yeah, it depends if you
6.5
include
other crypto.
Yeah, if you count
other crypto is even higher.
True, and if you count all above ground gold versus just
Right.
industrial gold,
No, I want it
non-jewelry
all
gold.
in people's teeth. We got to count everything.
Yeah, and then that's how you get 20 trillion,
Yeah.
actually.
All right, Tom Lee,
So.
thank you very much.
Thank you.
Appreciate it.
As we head to a break, let's give you a roadmap for the rest of the hour. The state of retail and the consumer, of course, going into the